Hi, I'm Keith McCullough, and welcome back to Hedgeye TV. I'm going to have a great conversation with a long time friend and colleague and analyst. Tom Tobin and I have worked together for, I think it's 20 years, Tom. I think we were talking about that this morning. It's in and around that zone. When we first met, neither of us had a gray hair on our head. We were just strapping young man, trying to make a difference in the hedge fund world. And, our offices were, actually joined when we worked for Dawson Sandberg way back when. But the point on that is that, one, we've been on this journey together, and it really is a journey of trying to learn every day and trying to teach ourselves what we don't know, which is manifest. Making a lot of mistakes together. We've both done that. We've had a lot of victories, too. But what I really wanted to give people an opportunity to learn here today is to listen to a pro-to-pro conversation that's real from two people who have done it. And I think that that's a differentiator versus what a lot of people have access to on Twitter is pretty much people with opinions on stocks, right? But you have a process for that. You're our healthcare sector head, and maybe I want to start with that, like the cornerstone of your process, which you also wrote about in the early look note this morning. Maybe just start with that, like how you start your day and what the process is to come to your conclusions.
Yeah. So we've been the first point of that note really this morning too is to talk to just how much innovation and sort of getting a little bit better, altering your process a little bit at a time. It's never done, and it's always different. And then just even going back to the early days when you and I were together, like we were reading books on how to detect, a liar, kinesics and, forensic interview techniques. And, I was one of the first customers of expert networks at Gerson Lehrman and before there were non-disclosure agreements. And, so this process and the game or how we used to talk about, we do more meetings, one-on-ones with anybody than anybody. This thing is always evolving. And I think the latest iteration for us has been really trying to plug into the quantitative view, or at least create a bridge between the quantitative factor setup that you and Darius and the macro team sort of deliver to us, and really try to bring that down to the stock level, because so often you can be right fundamentally and exactly correct on the quarter, and then you get blown up on the stock. And getting sensitive to that really is a matter of getting sensitive to what the machines are doing, getting sensitive to what the algorithms are doing, because your fundamental view might have been super cool and exciting when you're getting paid 2 and 20 and in 2000, like our bosses were, for doing lots of meetings, because, the CEO would give you a little body English on the answer to the question. And you were like, oh, let's buy a 5% position. Today you're competing with robots, and you're competing with just a flood of information, and sort of providing context for, your wonderful story. Yep. Is really, I find, to be the hardest part. The stories still matter. But really how you couch that narrative in sort of a context of data really for me has become the trick of how do I optimize my day? How do I stop inventing new things? How do I really knuckle down on a process? So our day really starts with, looking at prices, the rate of change. We look at estimate revisions in particular. That's really what backs into our method. Mm-hmm. We look at a lot of news flow, again, being sensitive to all those small changes in the narrative. And out of that, we produce, we've been producing this morning note lately, which sort of encapsulates all that. And then we do a position monitor update on Mondays where, again, we're reviewing, okay, this is what happened with the stories, with the data, lather, rinse, repeat, look forward this week, next week, et cetera, and try to refine it the whole entire time. Mm-hmm. In terms of, what you were asking about, like the cornerstone of the process for us really has been sort of a couple of years of trying to figure it out. Like when you tell me, factor exposure of, beta, healthcare, multiple debt, like all that, the quad 3 setup versus the quad 2 setup, and, figuring that out at the stock level can be challenging, right? Because if you're long misses numbers, it's going down, or if you're positioned incorrectly on a short, you're going to get your face ripped off, which is, I've got plenty of experience doing both of those things. But this quad setup that we've kind of translated is just, is my estimate trend, at the upper end of a growth curve and accelerating, or is it at the lower end of a growth curve and decelerating? And sort of those four quadrants have super informative of, at least providing a context for how to think about this next quarter. Like, is the threshold really high for a beat? Is the threshold really low for a beat? And what's the probability the stock's going to react, a certain way positively or a certain way negatively? And just using that as a risk, like a risk tool, a context tool. And we've had some really good successes, particularly recently, as we've turned that more into a production tool than anything else.
Yeah, I want to get down to the screws actually on that for people, because people that are listening to this are trying to learn how to build their own process. And the key thing that Tom just said is he just redid the whole thing in the last couple of years. Again, when you're doing it for 20 years, you have to understand that the game has changed. You have to evolve alongside the game. There are very few people that last in this hedge fund game for a long, long time, unless they're doing just that. I just want to call out from a top-down perspective one slide just to highlight what Tom just said. Like on slide 4, guys, if you look at that, we basically, when we came into this business, Tom, that we were literally at the beginning of that of this chart, and that's where you have global hedge fund assets under management just inside of $1 trillion. So if you're running like $1 billion or whatever, like you're at a firm like ours, Dawson Sandberg, which became Dawson Geomology, Dawson Herman, and everything. I mean, that's a totally different game. Look at where ETFs are at the beginning of that chart relative to hedge funds. They didn't even effectively exist. Now that's the point, is that when Tom says the machine is the black bars, and the machine drives the flow. So what you have to do is stay ahead of the flow. You got to stay ahead of the flow from a quad perspective. What economic quadrant are you in? And then once you go, okay, so now I do or do not like these sectors in each quad in healthcare. Then Tom goes to the next level. And that's what I want to do now, which is basically that. Like, it didn't start that way. I mean, when to be clear, and tell me if this is a mischaracter, and this is why I call people Captain Stockpicker. Guess why? I was Captain Stockpicker. I know him really well. And Tom was too. I did 256 meetings, one-on-ones in 2003, by the way. That used to be my marketing deck when I started my hedge fund. 256 one-on-one meetings with companies, right? So if you had good, reading and comprehension skills, and you could read people's faces, you could make a lot of money. And that's what it was. Now, in this day and age, if you don't know where the quads are, the economic conditions, the probabilities, and what the machine's doing, just starting with some big things, you could, Captain Stockpicker, walk into an earnings event and be right, quote unquote, on the fundamentals and lose your job. I mean, that's basically where we're at. Is that a fair characterization of how the world's changed?
Yeah, I mean, I often fantasize about it, but I often think about, like, if I was, the algo guy, right? If I had the wherewithal and the mental capacity to write an algorithm that traded stocks, and, like, heaven forbid it wasn't working one day, or maybe for 3 days in a row, or maybe for a week in a row, maybe I'm getting a tap on the shoulder, maybe I'm getting, my gross exposure reduced on me, like, you're still feeling emotion. You're still feeling like all that horrible stuff. So there's an element of, like, where the quant tries to position itself as, dispassionate, investment technique. At the other end of it is, you can meet with the CEO. You can think this product's the greatest thing since sliced bread, that it has, it's going to grow to the moon, but nobody cares, right? So the crazy position that you have to be in is, well, I have this, I've built up all this conviction on where this thing is going, how many units are going to sell at what price, and how profitable it's going to be, 5 years away from now, or, in some of these crazy multiple stocks, like 10 years away. And what you come back to is, like, you could be getting tossed this way and that, and it has nothing to do with any of that, right? So your view on the fundamental side, nobody cares, right? And you're getting trolled on Twitter because it's a dumpster fire, which is what I was, when One Medical was at $26 earlier in the summer, you're like, oh, another dumpster fire from Hedgeye Healthcare. And, now it's, I think it's a $50 stock. I think it's a $100 stock. I think it has sort of, but you have to sort of resolve yourself to being, not callous to the price movements, but do your work, but also anticipate that there's all this, like what you're talking about, all that factor exposure, all that machine led trading. The ETF is my stock in an ETF. Is there demand for that ETF that's artificially driving the bid? I mean, it's crazy to the point where you're better off just saying, okay, there's a lot I don't know. I'm going to take a step back and I'm going to try to be really sure about the things I do know. And, again, going back to Dawson Herman days, like make a concentrated bet, be able to stand in front of a 5% decline, a 10% decline, and double down and with conviction.
And in particular in your world, and that's I'll never forget the lesson that I'd hear you getting. There's really a different kind of a teaching methodology in the hedge fund businesses, as everyone may or may not know, which is you get yelled at a lot, and people yell and break phones back then when people had phones and break desks. And I've seen Tom deal with all that. But one of the biggest reasons, Tom, is because in particular the closer you get to these growthier names or biotech, God forbid, there is an open envelope nature to the idea, and that's what makes your job very difficult. It's certainly not for somebody who's just wearing a hoodie thinking that they like something or don't like something. Please don't do that. But anyway, I digress. Let's go to maybe show some visuals on how you go from, let's say, okay, Keith's saying right now it's quad. Well, let's say what we're saying. We're quad 3 and pending quad 2. So what does Tom do with that?
All right. So if Eric could pull up that slide, I guess my number slide 4, this micro quad model versus actual. And essentially what we've done is taken all of our earning estimates and translated it to that sine curve on the left-hand side, and you can see the numbered quads really translated into the boxes on the right. It's super simple, right? It's simple to draw essentially a pencil. Take a pencil and draw a line through an estimate trend. And you can think generically like, company misses numbers, estimates bottom out, they sort of stay stable for a bit, things start to get better, the management looks more confident over time, your checks come back positive, and then all of a sudden the stock's not going down at the same rate of change, estimates are going down, and you get to that one quarter where the thing just, blows up, blows out to the upside. And the same is true for tops. Like you get a couple ratty quarters, they're explaining it away. That product line is slowing. That's driven the stock from nothing to the greatest thing ever, and you roll over. And so that transition from 4 to 1 is sort of where you're getting the growth reaccelerating off the trough. And when you're in 2, basically be long everything. And then as you're rolling into 3, where things are slowing and decelerating, you're running the risk that you're gonna fall into some deep dark hole. And what's really great about this chart is that that's what it is, because but the best part about this is that this is sort of spanning any macro quad environment. Like the stocks behave essentially the same. The amplitude is hugely different, and you definitely want to be shorter of in your macro quad 4. And then depending on what the rotations are in and out of healthcare or beta or the other factors, which layer that on top of this. But what you see on slide 5 is, it actually works. And this was kind of the crazy thing about this whole methodology, is that if I measure, the 1 month forward, the 1 month performance against that generic sine curve that I've calculated for now, it goes back, I think, 6 years. We got 6 years of data, daily basis, across I want to say 150 names within my group. It just like if I get that quad thing right, if I get where are we on the growth curve, and are we accelerating or decelerating? It tells me so much about what the stock's going to do with the next fundamental data point. Whatever cool thing I figure out, whatever clever whatever web data we figure out, I get to capture that performance. Or at least I'm ahead of the game with a high probability outcome.
And on that, just a question on that, so people they can probably read it at the bottom. But estimate trend, you're using Old Wall or Bloomberg analyst estimates. Yep, FactSet. Yeah. Okay.
Yeah, you take the next. So they calculate it for you, and there's a next 12-month estimate trend.
Yep.
It captures, this methodology. It screens or filters out big acquisitions, divestitures. It punishes companies that cut guidance so that when there's a sudden drop, it sort of diminishes the big gap ups in terms of performance, in terms of a beat and raise, and sort of numbers are gapping up. But if you look at what actually happens over time, you can see on slide 6 is those are the two curves, so that you can see what's actually happened with healthcare over an extended period of time, and then a color-coded, well, was the group on average in one of these quadrants, and then what was performance. What's not on there should be a table. If you look on the price index table on the next one, you can see this is where the performance really sorts itself out on slide 7. And so that lower box just tells you, so if you're within that sort of 3, 1, 6, 3 or 1 month time frame, you get really significant separation between the micro quads. So if I'm just happily short a quad 4 name, and I'm not running the risk of moving out of that range, that really lowers my threshold for staying short. If it's at a risk of moving out of there, moving into 1, moving into 2, heaven forbid, that's where you get sort of your pin action on, hey, I've overstayed my welcome on a short, or overstayed my welcome on a long that's moving from 3 into 4 or 2 into 3. And you can see this has actually shaped up really, it's been super useful, as we're continuing to press it into our daily routine and our weekly routine, and it's been incredibly helpful.
Yeah, that is, and again, we're trying to simplify the complex here. There's a lot of data and analytics getting thrown into the machine here for us to front run the machine. So that's kind of the point, which is, if you go back, I think you go back to slide 6, guys, that Tom just had. I think it was the side-by-side. Can you pop that up one more time? Go back one more, right there. So that, when you look at the actual performance versus the growth curve, that is what it is. You're basically using math in the machine with publicly available information, by the way, and sentiment-oriented data, which is people's expectations of the future, to front-run the machine. That's all we're trying to do at every single level. Is that a fair way to summarize it?
Yeah, I mean, I combed what I was. The reason I ended up here is because I was combing through, I looked at short interest. Like, do I want to be long or short of short interest, right? And how does it behave across all the macro quads? And what I found is that there's a kind of threshold of 8%. Anything above an 8% short interest tends to be an underperformer. It tends to be a place you don't want to take the other side of a high short interest stock, and the high short interest level was really this kind of 8 to 10% level. But it wasn't like it was giving me any value in sorting out of Keith says it's quad 1, everything goes up in quad 1, and trying to figure out what went up more versus less was really a function of the estimate trend. Yeah. And because the estimate trend is what really I think ultimately we all have to kind of agree that cash flows, which start with revenue, essentially sit underneath these trends in terms of the price. At the end of the day, at some point, depends on how far you want to look in the future for some of those biotech stocks. But yeah, like sorting through all these factors, this is where you end up, right? You end up, and it's not just your 2021 estimate, right? Which tends to be pretty static. It's really the continuum of, how fast is it growing? How steep is it growing? How is it relative to where the company's been? How is it relative to where it's going? And are you in any one of these, peaks or trough moments? It's just, and then ultimately gives me a tool to look at my fundamentals, right? So if I've got a stock like Teledoc, which has been pretty consistent micro quad 3, I should say, it really hasn't performed, particularly well throughout its whole time here in this kind of slowing. It's on the back end of COVID. Any name that's kind of in the back end of, like, anybody who benefited from COVID is in this back end of deceleration and really hasn't performed all that well. The next piece of that, though, is there an inflection point coming? And how does it relate to the prior year? And what's the data that I need to know to get me there? Is it going to be mental health? Is it going to be, them buying more stuff, which they've done very well in the past?
So you put that, like, again, one more time, just to make sure everybody's got it. Go back to slide 4. Tom, what you did here is an awesome job, by the way. Our whole team, I'm sure, is like, wow, that's finally somebody color-coded it and put it together in a sine curve. Again, so it's like you buy when you're coming out of the 4 and into the green, so you're getting a green light. And when the light is more green, then, like Tom said, a certified monkey can make money in that. Where the monkey gets killed is where the light goes yellow, and then by the time it's going more yellow, it goes yellow then red at its fastest rate, and that's where stocks crash and people die. Okay, or that's where people on the buy side die and go away, and it's a really simple thing to say, but it's a hard thing for people to do with discipline. In terms of like that is a much better way to think about the estimate trend before I start thinking about all these things in my human head that are my liabilities. Everything that we think in our head, emotionally or otherwise, is much more a liability than that data is. And that's something that it takes a long time for people to come to conclude that that's actually true.
Well, I've had 3 really good proof points beyond the teledoc recently. So Guardant has been one of my favorite longs. In recent weeks, we'd sort of been long into COVID, went short, and just made some mistakes over the last this COVID period, but long and strong right here. It was a micro quad 4 stock, and it wasn't really. It was behaving like one. It wasn't necessarily working very well. But into the print, I had very good data in terms of what that revenue was going to be. They printed that upside, and now we're back into this numbers moving higher, right? So, and it's moving higher at an accelerating rate. That's a very positive place to be. I don't have to worry about I do, but as long as I have enough shorts on the other side, I don't really have to worry about economic calamity, because I know on a relative basis and probably on an absolute basis, I'm going to outperform with that as a long. The same was true with One Medical, a name that sort of came through the fire of the summer. A lot of problems, a lot of skepticism about their unit economics. We've built some really good trackers there. I have a lot of confidence that they're going to go from 500,000 lives to something much, much higher, and then it's going to be a big stock. It's going to be it plays an interesting role in this new medical economy that we're all in now. And they put up really big upside. The stock's working again. Yep. And again, I think that the revision cycle for them will continue. I think there's a lot of upside. But again, as long as I'm in that area code of being in a high probability situation, I'm going to remain comfortable. I'm going to remain calm. I'm not going to worry about, hey, dumpster fire guy, or, some sort of, shorter term volatility in the name is I'm going to be much, much more comfortable. 10X was the same way. Like I just, when you can get into the data, and we have some of that later in this slide deck. Like if you look at the way this looks on an individual stock basis, if Eric can turn to I think it's the last slide we have in here for 10X, but slide 18 shows you that 10X has been this upper right hand quadrant, quad 2. It's been decelerating. It looks a little cautious in terms of where the numbers were heading into the print. But the chart on the right, that is a clever thing that we did, which is we figured out, well, how many NIH funded scientists are using their product? There's 300,000 NIH scientists. We count 2,000 that are using it, and based on our interviews, analog information, conversations, discussions, we think that 2,000 is going to something much, much higher, right? So absurd multiple on 10X. It's definitely going to grow into it, and this stock is like, talk about greatest things since sliced bread. That actually might be true, but so all I have to do now to remain comfortable is, I gotta update the chart on the right. Yeah. I've really simplified my life, and I got to make sure that 10X stays in that quad 2. I'm good. I will tell you to buy that all day.
So that and for people that are power users of the Hedgeye process but have not met Tom yet. You might be sitting there, and I frequently learn, like, it's not about I actually don't get called dumpster fire guy, by the way. I get called a lot of other names.
I mean, I like Twitter, but I don't like Twitter. I like Twitter, and I really don't like Twitter.
Oh, I love Twitter. I mean, but anyway, the point I was going to make was, like, a lot of people, they might know who you are through real-time alerts. So real-time alerts, as people know, ahead of the 10x. That's 10x Genomics, TXG. Ahead of the number, I basically hit the button and say, hey, look, Tom likes it. And it's not like he likes it, like I called him and he was like kind of scratching his head and it was a feeling type thing. It's data. And for people that basically subscribe to him from the institutional side, get that data all the time. It's updated all the time. So when I sell it in real-time alerts, we're not like, quote, we're out of it. Like, people need to get themselves out of their own comfort zone, which should be an uncomfortable place, by the way. If you learn how to pick stocks from, like, Kramer or somebody like that, that's not what we're doing. That's actually pre-2000 type stuff that we're just saying doesn't work. What we're trying to do is get you into the entire integral of the process. And that's the point, is if you're paying attention to what Tom's saying all the time, when I say, okay, look, nice call, Tom TXG, booking the gain in real-time alerts, that was just a trade. Right? So your confidence. So if you had a 4, 5, 6% position in that stock, if you're paying attention to what Tom's saying every day and he's updating his numbers all the time, you might sell like 50 basis points or 1% of your 5% position, 10% of your position, whatever. Now, so you're going to start to understand that the way that the game is actually played isn't the way that many of you that use all of our products assume it's played. Don't forget that a lot of you have never played the game at this level, and that's good. That's good. We're trying to coach you through that, and we're still trying to coach ourselves through not losing the next game. So I just want to make sure that people understand that, Tom. You basically have, do you have the 1-for-1 medical, by the way, just to show? Because I think that if we just showed 1M, which is ONEM, that's the ticker for that, TXG, and GH, those are the three that really have been working out for the right reasons, and that's what we really care about here. Do you have those charts or no?
Yeah, I'm just looking through this. I don't think it's teledoc, Mazzy, Illumina.
It's all right. So if we
I don't have it in here. But I'll put it out later.
Use show anyone that you want to call out, just so that people can see the discipline of it all and why it really just gets down to that picture.
Yeah, I mean I would say so Illumina I think is kind of an interesting story here because it's right on the cusp of sort of moving into this quad 2 environment. If you think about where Illumina has been for the last 2 years, it's been on this kind of, a new and untested CEO, Jay Flatley, who, dating myself a really long way. It's like I met that guy who built Illumina into this unbelievable powerhouse, innovative genomics company, which he's essentially, didn't invent the space, but he made it happen in many it was a $2 stock in like 2003 or something. I bet I've been the Grand Hyatt in New York, and I was like, it looks okay. I don't know, whatever. $44 billion later, they're going through their transition. Like they're trying to figure out. Well, they're on the other side of the fast growth that TXG is on, and frankly, the process I'm using for 10x is something I learned and refined looking at Illumina years ago. But where it is today is like it's been through a couple of product launches, a couple of big misses, drawdowns. Their underlying market is really changing and it's really maturing quite fast. But there's a lot of positivity, right? So I think the street's very skeptical that the new guy can make it happen. They just laid down an $8 billion acquisition for essentially a very expensive toy at this point in terms of pan-cancer screening, a blood test to screen everybody. It's unproven. It's a very expensive entry into a market that frankly isn't going to have reimbursement for some time and is going to cost them hundreds of millions of dollars to fund in the shorter term. But what I get though is if that top line, the Illumina's price correlates to their estimate trend to the tune of about 0.87 to 0.9 something. So that estimate trend for revenue, people don't really think about this as an EPS story. They don't really think about it as an EBITDA story. It doesn't, obviously have a lot of debt at this point, but it's really about top line growth. And from here, it looks like it's crossing over into this, sort of the wonderful land of quad 2. And what I'm getting overall is NIH spending on the right, picking up sequentially. The funding environment's been very good for NIH funding. In addition to that, they sell into not-for-profit genomic and biotech companies who are buying this equipment, trying to develop their own genetic tests that Illumina is already developing as well alongside them. And then the policy piece is that the government's trying to make it easier, better, more reliable to use all this genetic testing in the future. So I've got a couple of tailwinds where that really could support the underlying growth here. Plus, I've got the super sexy technology Grail thing, which is getting a lot of heat right now. But if they show just a little bit, I guess that's the point here is that they show a little bit of progress, a little bit of excess revenue growth from that product, a little bit of optimism. The threshold for Illumina working is very low, right? Mm-hmm. So if I can build confidence around a few data sets, a few key drivers, I could be supremely confident that it's probably not going down, and B, if they beat numbers by a little bit, it's probably going up a lot.
Mm-hmm. So a name like this, just to give people a sense of how we work together, and again, after 20 years, we're pretty good at tolerating each other's issues. We both have a lot of issues. He's got the dumpster fire thing going on. I get hate mail, but together we're pretty good. And what Tom does is he talks about a new name like that, and what I immediately do, which annoys him, is I'll go right to my trend signal and I'll say, I'm waiting, not yet. And what always happens to me when Tom's right is that the trend changes so quickly, and I miss that first big part of the move. So now finally, after 20 years, Tom has a page, one page, and I'm good at getting to the point when I get one page of data. When it goes to quad 2, I'm okay with the trend almost going to bullish. Now I'm not going to miss it. This is actually a big thing for our relationship, man, because it is annoying, right? How annoying is it for Tom Tobin to get on the call, our research meeting, which you can now listen in the morning, and go on and on and on like you just did about an idea like this that he's known for a long time. By the way, I was at Dawson when we were buying it way back then in 2003, and him not see me hit the button on this in real-time alerts, it's got to piss him off. Right? Yeah.
Well, it did piss. It does granted, I'm not done with Illumina, but it was One Medical I've been talking about almost every day for.
Exactly. There's another one.
Yeah.
So there's a great example of where and if you're listening to both of us, you say your name's Rob or your name's Robin. He or she is watching this, and she says, "Well, you know what? I think Keith's got it wrong again." That's your opportunity. Don't forget that we're just trying to do our jobs, right? I'm looking at what I'm looking at with discipline. He's looking at what he's looking at with discipline. And Tom's, forget his batting average, his slugging percentage on turns like this, when things go from bearish to bullish trend, it's a big time slugging percentage. So you should pay attention to that. Something that else that I'll do back to Tom, and I don't know if it excites him or upsets him, and I don't particularly care. I don't think I've ever asked you how it makes you feel. We don't do this for each other's feelings. But I immediately look up who owns the stock. I look at the short interest. I look at all the factor exposures that I care about, because what I'm trying to do is reduce Tom's idea to something that I have zero feelings about. I'm just looking at numbers. So now, Tom, as opposed to in the past, Illumina is not a high short interest stock. It's a low short interest stock. The coagulation of shareholders actually has some very smart longer-term holders like Sands Capital, for example, in the base. So if I were to see them selling the stock, I would be doubting you to a degree. But these aren't the things that we're seeing. I'm actually seeing a lot of attributes that I would want to see as a bull. And if I didn't see them, I'd call them out too. So I think that that's an important part of our process, our dialogue on these names, once you start talking to me about a certain stock.
Right. And listen, I mean, if you go to slide 8, you can see how what context Illumina sits in, which is this is how everything's sorting out, right? This is my immediate universe of companies that are highly correlated to sales and what their micro quad is. So I want to be long quad 2, maybe a little of the quad 3, and short the 1s and the 4s. It's, Guardant notwithstanding, because I had a lot of conviction on where that was going. But Illumina, again, it's like I've got a list of stuff to pick from. It's just a higher probability place to start. I could talk about Align, which, we were looking over the summer at the macro data in our space was, people were getting back to the dentist. They're getting back to the chiropractor. They're getting back to in-person care over the course of this COVID thing. I'm looking at these names with this context of all the other stuff that we're looking at on a day-to-day, week-to-week basis, newspaper articles we're reading, conversations we're having, and you can start to filter out with a little bit of context. As long as I stick to, if I'm looking for longs because you're telling me we're heading into this quad 3 to quad 2 transition, I should really only be working on micro quad 2 stocks. I should really only be devoting my time to figuring out what I've gotten wrong and exact, because I've been short for too long, and that's one of these places where we've hung around for too long. I'm long AMN. They had a great quarter. The stock hasn't worked. I'm not that worried about it because I think that's also got a good trend line here. But this sort of simplifying my life is macro quad 2, focus on the micro quad 2s.
Yeah, that's and again, I liken what Tom does to a great fisherman who was always a great fisherman, but now he has this thing called the fish finder. The fish finder makes one a better fisherman. Now, some people in our profession, the ones that are going away or have terrible performance and somehow still exist, but they just believe in their own mind, because don't forget that our profession is decked to the halls with people that have never had anything wrong academically in their life. They have 3.8 to 4.0s, they're super brilliant and smart, but they're not smart enough to change, and they're not smart enough to use the fish finder. So why, on God's good earth, would you take, if you're a great fisherman, like, I'm tremendous fisherman with a fish finder. I'm from Thunder Bay, Ontario. Of course I can fish. But I take 150 stocks. Why wouldn't I go to where the fish are? We go to the quad 2 list. The only thing that's going to confuse people about what you just said, Tom, is that GH was in the quad 4. So can you explain that? Because again, I often say this with the macro quads. Macro quads, yes, elegant, easy for you to read and understand, but not easy to execute on unless you're paying attention to the details.
So Garden is a great example of this situation where it was a double and triple down on the data, right? So studying what we were seeing across, so we have this a pretty detailed and I'd say not perfect but very good predictive value data series that tells us where how many patients have how many tests has Garden submitted to insurance companies. And what we were seeing, out of the summer, and as people got back to school, came back to work to a lesser extent, and then anecdotally, what we were hearing was a big recovery in particularly around oncology testing. So patients that had delayed care, delayed testing, delayed diagnosis were coming back into the oncologist's office, getting tested, modifying their regime, their treatment regimes. And what I was seeing was the Garden test volume really hook up pretty hard. And so when we were talking about into the print that the street was at 65 million and we were modeling 75 with upside for Q4, what did they say on the quarter? Well, they printed 75 and then they talked very cautiously about Q4 and the resumption of COVID. We're not seeing that in our data. So from this perspective, it's like what a micro quad 4 positioning does is really challenges your conviction. So right. I'm gonna scrub that to the point of I gotta be really sure. And in the same way with a teledoc or a Mazzy in micro quad 3 is which way is that? Which way are these like COVID comp stocks going to fall? Like, is it going to slide into quad 4 from here? Because the relative performance and the absolute performance across a lot of those names has been pretty meek. Right. And so is it gonna go back to the left, or is it gonna fall to the right? If it goes back to the left, it's a long. If it falls back if it goes to the left, it's a short. So that, and again, that it takes a high conviction data set, something that gives you, quote unquote, an edge, but essentially build your confidence intervals around. Well, I know what the stock cares about. If I can model what the stock cares about, I can front run the machine. Is kind of the simple story here. That's
a great answer. I mean, let's go back to the fishing example. So again, we have the fish finder. We put the boat in gear. We went towards where the fish are. But you still have, as a pro, your rod in your hand and you see bubbles near a lily pad. And it's not right there in the same quad that it says on our initial map. The fish are there, but there's one mother of a fish right over there. And you either can get it inside yourself to say, it's okay, there's a lily pad, there's a rock, it's quad 4, but I'm going to throw that line there and I'm going to get that sucker. That's what we're talking about here when we talk about top-down macro quads or micro quads. It's your initial sobriety check. You have to have it. You have to have it. Well, there's nothing on that page of those four columns of tickers, Tom, that asks anybody's opinion about anything. It's a machine-generated model base that you built. It's a machine-generated sheet that says "pay attention."
Right, and if you look at these, the pretty charts, like if you did go to slide 13, this Hill ROM, we've been kind of stalking this idea of where. What is telemedicine going to do to the physical infrastructure of delivering healthcare? I think you're going to need a lot less physical plant. Therefore, I think we're going to need a lot less, the capital spending that in equipment that Hill ROM sells. The stock really is in a great position to short here. But again, the color coding is that quad 2, the deeper the green, the better the performance. And if this, and what you get to do is, which way, where's the red dot going to go next? Can I forecast? Can I front run where that puck is going? Essentially, with 10x, I think it's going to be, it's going to stay solidly in that quad 2. With Guardant, I think it's going to resolve for quad 4, and it's going to skip through quad 1 and up into quad 2. Because again, this revision cycle is positive. The slope of the line is increasing, and on the margin, it's just it's a high probability long if you can build, you can build the conviction. But with Hill ROM, you've got this element where they have a very difficult COVID comp because people were buying, their specialty beds for the ICUs when the hospital industry was crushed early in this year. They're probably going through something similar right now, although to a lesser extent. And there's a whole narrative of, we're under indexed to ICU beds in the United States. Therefore, we need to buy more ICU beds. Therefore, we need more Hill ROM equipment. Therefore, Hill ROM is along. So that's a great story if true. Right. So the second part of this is I just haven't quite figured out how to model this thing. I've checked import data. I've checked, we've built a couple of algorithms for publicly traded data, that seem to really give us an edge on what organic growth rate is going to be. But it's just a question of I'm going to grind to a conviction level that red dot is gonna end up in that lower left hand box. That's
that again. I think people are really starting to get it right now because again, you're doing a really good job at just simplifying the process. Last question from me, and then we're going to go to your questions in the queue. And again, what I want people to focus on here, and some of you are asking already about a stock that Tom doesn't have an opinion on because you heard it on Hedgeye TV, Molecular Partners, because that's what. I think it was Mike T mentioned that one, Tom.
Right.
So but I want you to hear me very clearly on this, which is we want you to go from getting away from what are your picks to getting a process. Okay, it's not about picks; it's about having a process that generates a higher probability of good picks. Okay, we want you to get away from narratives, and we want you to get closer to numbers. Okay, narratives, like Tom said, sounds like a great story, comma, if true. A lot of stories you hear are bullshit, or they're just self-serving and somebody's pushing their own book on CNBC or whatever. So again, process is better than picks. Numbers are better than narratives. Have a numbers-based process, and you're going to do a lot better. So I just want to make sure on that. So again, anyone that's talking about any idea on Hedgeye TV, Tom's not working on Molecular Partners. So that's not what you should be asking him about. Just wanted to make that point. But I had a question just that in terms of, because you've mentioned it a couple times. One of your teammates on your healthcare research team, Justin, who recently joined, helps color up. The narrative does matter once you have the numbers and the process. Okay, so I don't want to say that narratives and picks don't matter. I'm saying that they matter after you get your numbers and process right. So can you just give an example of how you and Justin use, experts, which you'll have on the Healthcare Pro product. You give people access to a lot of different professionals in the field that have opinions, obviously, on a lot of these things.
So in most cases, and maybe healthcare is more, more like this in other spaces, where, I think oftentimes where people can, shop in a store, buy a product, use some sort of technology platform themselves. Healthcare is really idiosyncratic is a fancy way to say, I don't have a clue, right? So you have to, like 10x Genomics is just it's actually kind of a funny name, right? Because it's like it almost sounds like a scheme, like a promotional scheme, like 10x Genomics, and they might as well just put all the catchphrases like cloud and whatever else gets your multiple up. But the thing about healthcare is that each situation is so different. You can have your data set that's super predictive, your overlay is perfect, you have this correlation of 1 for the forecast for the quarter, and lo and behold, you're totally wrong and things break down. So the anecdotal part here is super vital, because there is so much information, I guess, still sitting in people's heads, right? People's experiences that are isolated from everybody else's and doesn't translate to a data set. In fact, a lot of the times what we do is we have a data set and we say, okay, well, this is how many people we think could use GoodRx ever. Let's measure this out. This is what they say their TAM is. You come up with your own sort of overlay on that, but you have to go test it, right? And the only way you can really test it is going and talking to a pharmacist. So we've talked to channel guys in the pharmacy world, and we've asked them, well, why don't you offer your own? And GoodRx is a drug coupon company that we've all seen the advertisements for. But why does drug couponing exist? Well, how does it actually work? What are the mechanics of how they get paid? And why are there no brands? And again, when you talk to somebody, you can often what we'll find out is there's some other data set, some other interpretation of what you're looking at. Like this, the chart is helpful, but you really have to always understand like what it is behind it, like how to, what the context is that you need. So what Justin's been doing, what we're bringing is a better process around, well, how do you find the right person, quickly? How do you build a rapport? How do you, sort of establish a bona fides that you can sort of credibly rely on somebody's input, and you have to do a couple of calls, and it takes some effort, and it's very person to person, hand to hand, unit to unit, and it's not easy. There's definitely a surplus of it on Wall Street. So the trick of, I think, of what we're trying to do here is blend the data with the anecdote, and I think data plus anecdotes can get you alpha. And as long as you sort of are, humble enough to listen to what somebody's telling you, and not just believe what you want your chart to say, it sort of improves the process all around. And we're constantly learning new stuff in these conversations, right? So you get to talk about, and it's just really fun to, talk to a pharmacist, right? For no other reason other than just to learn how the business works. Like, so that's a big part of what we do too.
Yeah, from a process perspective, it's not about asking the web a certain question. It's about how you think about what the right question is to ask, and that's a real important thing when you're really using data as intensely as we do, both as a firm and Tom's team. First question here, I'll pick this one, and again, I want to get people closer to process and less focused on picks. Again, this is not funny money or mad money, whatever the hell it's called. It's hard. It's a real process and it's hard. So Arthur from Detroit, thanks for telling us where you're from, Arthur. Asking about the long-term tail. So again, long-term tail or longer duration ideas. And to the extent that you do have convictions, it sounds like he's already long 10X, which is TXG, and Guardant, which is GH. Are you, and he's happy about that, so he's saying thank you, by the way, Tom. He's not calling you dumpster fire guy. He's asking, like, longer term, what are the curves, the growth curves, that, what names are your favorites longer term?
Well, everything we like is on the page right now. So, either it's a bench name that we're stalking and looking in terms of what you're seeing. So yeah, I'm sorry if my image is frozen out here, but
it's all right.
Yeah, so yeah, I love 10X. I think it's got a really long runway. One Medical, is akin to, if it has 500,000 lives, it could have 5 million. We think that's entirely doable. Again, it's a stock that $3 to $4 billion that could multiply by 4 to 5 times. Illumina is much more of a thinking about it in terms of a shorter term, like 1 to 2 to 3 year look. CVS, I think, of a company that is really sitting at the middle of the incumbent healthcare companies. It's managed care, it's a PBM, it's brick and mortar retail pharmacy. They've been really active trying to transform themselves into a digital health company. They've been trying to do the digital health transformation. So the interesting part about them is, like, if they make it, that's a big deal as well.
Yeah, that's a stock that's most recently broke out to bullish trend on a signal basis. I hadn't even paid attention to that myself. It's a good example of Tom and I over the years. He just keeps throwing these tickers at me, and I just keep looking. But that's a good example of a stock that's been shot for dead multiple times, and it looks like it's coming back to life here. So that could be a big idea. That's really interesting as well. I think did we lose Tom's audio? I don't think we lost his audio. We got his audio. All right, that's okay. We can. You look really serious in that picture we have of you up there, by the way. Question here from Drew. Tom, this is a very good question, because I asked you this question myself the other day. I think the teledoc LVGO merger. Are you a fan of it or not?
Yeah, I mean, they paid a ton for it. Right, it seems almost as crazy as the multiple that teledoc was enjoying right into the deal. It's really simple arithmetic. You have to believe in is that a couple 100,000 lives of Livongo can become many fold larger by penetrating the 50 million lives of teledoc. The question, I think, for teledoc here in the shorter term is that where they had been a super special, unique and large telemedicine platform, before COVID, that there wasn't it wasn't as common. Doctors didn't offer it. It was you would never have seen your doctor, on your smartphone before COVID, and now every doctor offers it. So, can teledoc, maintain its relevance and its positioning? Like Amwell is going to report after the close, and we're going to see, how successful are those guys at sort of being that service provider for the, for the physician and the physician and the hospital groups, being the platform more or less, rather than the patient who wants to get their script refilled or get a Z-Pack because they got the flu, or where teledoc has lived in a world of consumer convenience. Sort of the regular process of patients seeing their doctor and their doctor that they know is the back end of COVID. So Livongo for them is really sort of the check, right? So Livongo is this, a new opportunity where if they're successful, they're going to move this, essentially a diabetes platform. They're going to move it up into their own membership base. But it's a platform, so they're going to do congestive heart failure. They're going to do obesity. They're going to do any number of disease states that, that's a long-term growth story if they pull it off. And in the shorter term, you just got to make sure that they don't, if they miss numbers, that stock's going down a lot. So really, our job in the shorter term is to try to figure out, okay, one, are we going to make it through this COVID comp? Because they have a very difficult one, and when do you really start to see legitimate evidence that Livongo is penetrating? Some of the metrics we're looking at for Livongo are import-export data. So we're looking at container shipments. of their welcome kit. You can see that data if you're looking at the import data. We're looking at app downloads. We're looking at claims data. But we're also going to reach out to benefits administrators and try to figure out, well, why buy a PM product for telemedicine from teledoc if every doctor offers it, and at the same time, are you going to offer Livongo to more and more of your employees and more under your health plan? So there's a lot going on there to try to understand, but I think on balance, we still really like teledoc here.
All right, last question. This one from Shane in Vancouver. This is an excellent question. Hi, Tom. And he's asking about the estimates, trend measurement, and your methodology a little bit. Simple moving average, some sort of weighted average, et cetera, et cetera. I don't think and if you don't want to give it up, obviously don't give it up. But his main point here also in the question is some less covered companies don't have many estimates, so they tend to be pretty noisy and have a high degree of dispersion. It's a very good point. How would you react to that?
Yeah, I'm not going to play, right? So I'm not going to be down in, undercovered. It's very difficult to almost impossible for us to, in this methodology, to cover GoodRx out of the box, to cover Amwell out of the box.
Right.
So that is definitely a limitation. If we can't see it, measure it, we're not going to play. Mm-hmm. I don't particularly like, less liquid and, spotty estimate coverage, because it does feel like the relevance of the the computer and the algorithm and the ETF and all that stuff. If you're completely outside of that pool, you're going to have not only is nobody going to care about your anecdotal supported narrative, they're definitely not going to care about your stock. Right, so you're going to be operating in the worst of all worlds, which is essentially in a full sensory deprivation tank of information.
Yeah, that's a really important way to answer that question, and it's also something that people spend a lot of time, particularly with biotech. They're looking at a lot of these kind of narrative-based high beta stocks that have no coverage. I mean, it's certified gambling. Let's just be clear. Unless you think you have a research edge, then go for it. But over time, you might learn that you don't have the edge that you thought. Yeah.
In the biotech, that kind of story though, then it can play a role in a portfolio. It's just not. It's not a role that I'm going to have it play in my research product.
Right, which is fine. I mean, that's and staying true to your process and having the discipline to do so. It's one of the hardest things to do. It's also, as we've gone through this conversation, and thanks for having it. It's super important to evolve and change your process. The tools are different today than they were 20 years ago. He's still the same guy. I'm the same guy. Well, I'm definitely fatter and older and all that stuff. But the reality is that we're humble enough to understand that we don't know what we don't know. And that's an important part of Tom's process each and every day. I certainly love working with him. So hopefully you love this conversation. And Tom, again, thank you for putting all that together. I think I've had actually some of the analysts on our team, some of the veterans have texted me throughout this conversation saying, when did Tom come up with that presentation? So I think they want to borrow it is the point, and they probably should. So thanks for doing that too.
Yeah, and I'm sorry about the camera action, Keith, but thank you this has been really fun.
Yeah, it's awesome. We'll do it again. We'll do it again sometime soon. Thanks for tuning in. He's Tom Tobin. I'm Keith McCullough.